History doesn't repeat itself, but it often rhymes. In 2008, it was residential real estate and mortgage-backed securities that took down the global economy and caused the global financial crisis. This time around, it looks like commercial real estate and commercial mortgage-backed securities may be what causes the crisis this time around. And before you tell me, sir, this is a McDonald's, that's entirely my point. There's news out of McDonald's today, and the financial press is largely ignoring it. It has nothing to do with hamburgers and people eating out. It has everything to do with commercial real estate. And when you combine that with recent stories about the Silicon Valley bailout, news from Blackstone, warnings coming out of Europe, and mayors and politicians in every major city around America scrambling for some semblance of a return to the office, becoming painfully clear that commercial real estate will be the straw that breaks the camel's back this time around. Here we go in Reuters, dated just yesterday, McDonald's temporarily shuts U.S. offices and prepares layoff notices, Wall Street Journal reports. Burger chain McDonald's Corporation is temporarily closing its U.S. offices this week as it prepares to inform corporate employees about its layoffs as part of a broader company restructuring, the Wall Street Journal reported on Sunday. In an internal email last week to U.S. employees and some international staff, McDonald's asked them to work from home Monday through Wednesday so it can deliver staffing decisions virtually, the report said. It's unclear how many employees will be laid off. Now, folks, this is very important because contrary to popular belief, McDonald's is not in the hamburger business. McDonald's franchisees are in the hamburger business. McDonald's, the corporation, is in the real estate business. More than 3/4 of McDonald's profits comes from rent paid on the properties that the corporation owns that it rents out to franchisees. McDonald's is in the commercial real estate business. They just closed all their offices because they're about to lay off a bunch of people. And you're going to see that this theme of problems in commercial real estate is rearing its ugly head all over the world right now. And it's about to cause serious problems for the economy and for America's banks. Now, before we get into all the alarms that are sounding on commercial real estate, I want to talk about today's sponsor, Patriot Gold Group. Now, if you've been following this channel for a while, you're familiar with Exter's Pyramid, which depicts the many different asset classes and the counterparty risk associated with those assets. The higher up the pyramid you go, the riskier the investment becomes. And right now, counterparty risk is a hot potato that nobody wants to be caught holding. During events such as crypto frauds collapsing and more recently bank runs, the upper layers of Exter's Pyramid can become a no man's land where anybody caught up there holding the bag can be wiped out. And that can create a stampede down Exter's Pyramid as investors flee from those riskier investments and take refuge at the base of Exter's Pyramid. And all the way down here at the very base of Exter's Pyramid is gold, the safest asset you can possibly own. And that's why I'm happy to be working with Patriot Gold, who is a Consumer Affairs top-rated gold IRA dealer for 6 years in a row, and they're proud to offer the no-fee-for-life precious metals-backed IRA. These self-directed IRA accounts are backed by physical gold and silver stored in a private depository with segregated, secured storage and insured by Lloyd's of London. So go to nsfgold.com. I'll put that link down below in the description, or call 888-988-5401. Get your free investor's guide. Ask about their no-fee-for-life precious metals-backed IRA. And, of course, be sure to tell them nobody sent you. Now, over the last few weeks, with the failure of Silicon Valley Bank and Signature Bank and Silvergate Bank, of course, Credit Suisse over in Europe, there was a lot of talk about unrealized losses from bonds. Like this headline, banks in the United States have unrealized losses of $620 billion. Well, this was only referring to losses from U.S. Treasuries. As the interest rates on those treasuries rose, the bond prices fell, and banks hold a lot of their assets in U.S. Treasuries. So all the talk about losses in the banking system of the last few weeks has really just been limited to losses from bonds, specifically U.S. Treasuries. There has been no actual realized losses from commercial real estate yet in these bank runs. Emphasis yet. So far, the banks have not been forced to sell their commercial real estate in order to meet withdrawals. And that's why this article here in Market Watch is very alarming. How the FDIC set a baseline for troubled commercial real estate. This is dated April 1st. The Federal Deposit Insurance Corporation's latest action, selling $72 billion of the failed San Francisco bank's loan to First Citizens Bank shares at a $16.5 billion discount, underscores a difficult environment ahead for all sorts of lenders and businesses. And this is what's so worrying here. But what about that tremendous discount of SVB's commercial real estate loan portfolio? Joy Wiltermuth interviews several veteran CRE investors, one of whom says that 23% discount on the loans sold by the FDIC has set a baseline for the commercial property credit market. Going further, Capstack Partners CEO believes the implied valuation of 77 cents on the dollar is the top end, not the bottom end, for commercial real estate loans. So what they're saying here is when the FDIC sold off all of those assets that were left on the books of Silicon Valley Bank for 77 cents on the dollar, what they did was they set the baseline for losses in commercial real estate. Keep in mind, the FDIC had to put all kinds of goodies in that deal, like lines of credit and backstopping deposits, in order to get First Citizens to take that deal. So 77 cents on the dollar is now the best case scenario for commercial real estate debt in the United States. If you're sitting there with a $1 million loan on your books, the best you're going to get is $770,000 for that loan. And that's why it should come as no surprise that we're seeing stories like this. Real estate leader on New York Fed board warns on commercial real estate risks. And this came out last week. An executive who also serves on the board overseeing the New York Federal Reserve warned on Twitter Friday of potentially systemic problems in the real estate finance market and called on the industry to work with authorities to avoid things getting out of hand. Noting that there is $1.5 trillion in commercial real estate debt set to mature in the next 3 years, Scott Reckler, who is CEO of RXR, a large property manager and developer, tweeted, "The bulk of this debt was financed when base interest rates were near zero. This debt needs to be refinanced in an environment where rates are higher, values are lower, and in a market with less liquidity." But folks, it's that $1.5 trillion number that's going to mature in the next 3 years that should worry you. Remember, according to the FDIC bailout of Silicon Valley Bank, baseline scenario, this $1.5 trillion worth of loans maturing in the next 3 years is only worth 77 cents on the dollar. That means in addition to the $620 billion of unrealized losses on the bank's balance sheets from U.S. Treasuries, in the next 3 years, best case scenario, they're going to lose another $350 billion just from the commercial real estate loans that are going to mature in these next 3 years. And as I've mentioned in some of my prior videos, almost all of this debt is sitting on the balance sheets of America's small regional banks. And of course, Scott Reckler, who is one of the guys on the board at the New York Fed, he stands to lose a ton of money with his company, RXR. And so he's saying, hey, the Fed and the FDIC, we need to do something about commercial real estate. Maybe somebody here ought to point out that one of the guys on the board of the Federal Reserve has a little bit of a conflict of interest here, that he stands to benefit financially directly from any Fed bailout of commercial real estate. Or, they could just go ahead and investigate themselves and find no wrongdoing and move on to the next scandal. And this is not a hypothetical scenario, folks. Check this out here. Defaults on commercial real estate loans surged to a 14-year high. The jump in distressed debt could prove ominous for landlords and banks that loan to them. Distressed commercial real estate loans rose to 5.2% in February, and corporate debt defaults are at their highest since 2009. And you'll see that this is spread pretty evenly across all different sectors of commercial real estate. Office properties accounted for 44% of all defaulted commercial mortgage-backed security debt transferred in February to special servicers to work out payments, according to CMBS data firm TREP. Debt backed by retail properties comprised 32% and multifamily 19%. So offices are clearly the worst performers here, but we're also seeing increases in retail properties and multifamily residential. The entire commercial real estate sector is in trouble. And so is it any surprise that Blackstone's BREIT, or the Blackstone Real Estate Investment Trust, saw $4.5 billion of withdrawal requests in the month of March? Emphasis on requests because Blackstone is not granting most of those requests. The real estate trust has limited redemptions for 5 months. The firm says the structure is designed to prevent a liquidity mismatch. What they're really saying is if we allow people to withdraw their own money, we'll have to sell some of these commercial properties, and that will drive down the value of those properties. We won't get anywhere near what we paid for them, and we'll lose a lot of money. And so we're just going to slam the door shut and lock them and lock everybody inside our fund. Blackstone's $70 billion real estate trust for wealthy individuals faced higher withdrawal requests in March and restricted redemptions for a fifth straight month. Shareholders asked to redeem $4.5 billion last month from Blackstone's real estate investment trust in a month of tremendous market volatility and broad-based financial stress, the company said on Monday. BREIT allowed about $666 million to be withdrawn, or only about 15% of what was requested. This is now 5 months in a row people want out of this fund, and Blackstone is only allowing a few people to withdraw a little bit of money at a time. They've taken away the sell button in order to prevent this fund from crashing. And for you folks across the pond in Europe, this one affects you as well. Check this one out, dated just today. ECB warns of risks posed by €1 trillion real estate funds. Funds investing in commercial property pose a threat to financial stability after growing significantly over the last decade, according to the European Central Bank. Folks, that is a very strongly worded statement. They pose a threat to financial stability. What they're saying here is, hey, this could crash our banks. This could destroy our financial system. They're not saying this could cause stocks to go down a little bit or maybe some people would lose some money. They pose a threat to financial stability. That is very strong words from the European Central Bank here. The net asset value of real estate investment funds more than tripled to more than €1 trillion in the past 10 years, boosting their interdependence with property markets, according to the ECB. When you hold interest rates in negative territory for a decade, don't be surprised when the value of things you can buy with borrowed money balloons out of control. Now they're raising rates and they're going to be forced to deal with the consequences. The ECB warned of a mismatch as investors have frequent opportunities to withdraw money while the assets themselves are quite illiquid. That can make the vehicles vulnerable to runs like those that reverberated through the financial system recently. Instability here could therefore have systemic implications for commercial real estate, which could in turn affect the stability of the wider financial system and the real economy. Commercial real estate is not a liquid market. It's hard to value these things. It's hard to sell them. It takes time. So if investors are withdrawing their money, these fund managers will not be able to sell the property fast enough in order to meet those withdrawals. So they'll have to lower the prices they're charging for those properties, and it could cause a crash in commercial real estate prices. And of course, in typical tyrannical fashion, the ECB's proposed recommendation is that rules should be developed to help funds better manage spikes in liquidity demands and to internalize the cost of redemptions which can arise during market stress, according to the article. That could include lower redemption frequencies and longer investor notifications, it said. In other words, the ECB's proposal is when there's a stampede for the exits, slam the door closed and lock everybody inside. That is the proposal being floated by central bankers. So take all these stories in aggregate. McDonald's, which is really a real estate company masquerading as a burger joint, they're closing their offices to lay off a whole bunch of people. Why? Because they're about to take a big hit from commercial real estate. Combine that with the FDIC unloading Silicon Valley Bank's commercial real estate loans at 77 cents on the dollar, which is now the best case scenario for future real estate transactions in this space. Add to that the unrealized losses from U.S. Treasuries, the $1.3 trillion in commercial real estate that's going to mature in the next 3 years, according to that New York Fed director, the rising rate of defaults. We've got the same problem over in Europe. Folks, it is increasingly looking like commercial real estate, CMBS, CLOs, commercial real estate loans, that this will be the MBS and the CDOs this time around. It'll be commercial real estate that takes the system down. And of course, it's during events like this that you get that flight to safety, that stampede down Exeter's pyramid into safer assets like cash and gold. Once again, thank you to Patriot Gold for sponsoring this video. And until next time, live small and dream big.